Blah. All right, you are live, Joshim. Take it away.
Ready?
Yep, we are ready.
All right, guys. It's this week it's gonna be me because Landon couldn't make it, so I'm standing in and I'll try my best to make it worth your time. So this week is on risk management, and if you can take what I teach you today, it goes a lot further than just trading. So to begin with, we'll start with the basic stuff. What is risk management, why it works, and how to use it. If anyone's backtested before, they might have seen a spreadsheet like this, calculating how much we make, how much we lose per trade. Without risk management, we're subject to bigger losses, smaller wins. Essentially, we'll just end up with less than we should, and maybe ending up unprofitable where we should be profitable. So why does it work? With risk to reward, we've maybe seen something like this, like where you measure your trade, how much you could lose, how much you could win, and that's our risk to reward right there. So to be profitable, we need more than 50% with a one-to-one strategy, and there's our chart to explain all that basically. Most of you probably know about this, but just a quick summary of the basics. But it goes a lot further than just risk management with your trades. There's the risk of being wrong, for example. It could mentally affect you by being wrong, and you need to manage that risk by having expectations of not knowing everything in the market. So when I first started trading, I felt so talented and I felt like I could know where the market was going to go all the time. But there was a huge risk that I was just making bigger and bigger, the risk of being wrong. And if I was wrong, that would mentally affect me so much. And I could even go to the point of blowing my accounts because I just couldn't take the idea of being wrong, even though what we do is essentially gambling and we're wrong all the time because of it. So we need to manage that risk and we need to understand that we can't be wrong when we're trading. And there's nothing wrong with being wrong, of course, because we are just gambling. There's also the risk of inadequacy. The risk of inadequacy is when trading, we are our biggest risk. Most of the time, when we're trading, it's not our strategy that can mess us up, it's us. So we need to make sure we're trading well and we manage that risk by having rituals and the good habits. So, for example, there's the risk of not sleeping well enough for months upon months upon months, maybe even an entire year. I had a strategy and I was so good at trading. I had everything down, but I just couldn't sleep. I was waking up way too late. The risk of not sleeping was too big for me, and I managed that risk. I tried to manage that risk, we'll say, with sleeping pills. I used something called 5-HTP, and I used melatonin, and I used serotonin. But that also comes with another risk. So we see how all these risks are layered. You see this, how managing risk goes a lot further beyond just trading. It goes into every single thing we do. So the risk of taking 5-HTP, it messes up your brain chemistry. So I would wake up very depressed. I would wake up so depressed because this drug that I was taking to help me sleep, it came with the risk that it would make you less happy, like you'd be less sensitive to dopamine. And I was just unhappy. I was trading a little bit better because I was able to sleep, but I wasn't happy. And that's what we trade for, right? We want to be happy. We trade for money because we want to be happy. So there's so many risks with trading, and we need to make sure they all line up. We need to manage all of these things. Like, we risk the thing we trade for by trading. We could I used to live a double life. So I started trading at 18 and I wasn't able to tell my parents or anything because I didn't want them to think I was crazy making money out of candlesticks, you know? No right-minded kid would tell their parents they're trading. Like, when you're in a family household like me, it doesn't work. They would try and convince you to quit trading. And the risk of that was I was going to drift away from my family because I couldn't tell them what I was going through. I was losing all of my money and I couldn't tell them. That was such a huge risk. By not telling them, they could find out and I would feel so much shame just by being broke because I worked for 2 years and I saved up a lot of money and my family thought I was doing well. But deep down, I lost everything from trading, and the risk from them finding out, that could hurt me a lot. And I didn't want them to find out. And there's also the risk of freedom. So when you're trading, you have to be focused. Most of us don't have super simple strategies where we can just doze off, do whatever we like, and just trade with it in the background. I tried that and it didn't work for me for a long time. I kept trying to make it work by trading with only 50% of my attention, maybe even less than that. And it always ended up with unprofitability, just bad times in my trading. So it does take a lot of freedom. Trading really isn't what it seems like. It's not this super easy thing. It's not this dream job where you get to just sit around, make money with a click of a button. You have to be focused, and it does take time. It is a job at the end of the day. It might not seem like a job because it's not a normal job, but if you want to treat it like a business where you employ yourself, it is a job. And so it does take freedom, it does take time. And that is a risk. Maybe you don't want to spend your time like that. The risk of spending your time like that, you might not have the mental health, the mental capacity to spend more time like that. Because a lot of us, when we're trading, we need to be working as well. We don't start as traders profitable. We have to make money. We have to make a living. And using that time trading, and then alongside all the other things we do, we might work jobs. When I started trading, I was doing night shifts. I would leave the house at 5 p.m. and I would get home at about 10 a.m. And then I would sleep for a couple hours and I would trade. And I would trade from maybe when I woke up all the way until I left the house. And that was every single day. And the risk of doing that was I was going to lose my mind. And eventually I did lose my mind. I had to quit my job because it was too much work. This is a job. The risk of trading is that you are spending time, and the risk of spending time is work, and the risk of work is mental health. We can only do so much work. There's also the risk of not eating well enough, and that goes under managing the risk of performance because we need to feel ourselves properly to perform. And the risk of not eating well enough is our health and our mental cognitive performance. So there are foods like fish, and because fish has omega-3s and good fat food and good fatty acids. So there's like fatty acids that will help your brain perform, and that comes from fish and other meats. You also need iron, which is in a lot of beef. You can have beef. A lot of meat is really good for your mental cognitive performance. So reality, he went on a carnivore diet, which it's something you should do on research on. You don't want to just jump into a completely new diet all of a sudden. So carnivore isn't for everyone, but it can be very good for your brain, and that will help you trade. So that was this time where I just completely locked in on my performance. I was using all these different pills, all these different things. And one of the things that I needed to do, which was more important than any pill, any supplement, was meat. Meat is just so good for your brain. It helps you perform to such a high standard. And when you have like a complex strategy, when you're going beyond just baseline profitable, you need to be performing high, like very, very high. Because if we just go onto my chart real quick, there are so many layers to my strategy because I went way beyond just baseline 60% one-to-one trading. I went with laddering out of trades, hedging trades, double entries. There was so much going on in my trading, and I was trading 3 charts at a time at one point. I was trading maybe, sometimes I was in 10 different trades at the same time, managing them all, and I had to entry, exit, add more, take away less as it was in profit, add more as it was going down, all these different things going on, and I had to be laser focused. So right here, let's say if it was back in the day, maybe I had 3 charts opened up. This is the 1-minute chart, by the way. The day's just started right here, and then I'm entered already, and then on another chart I have to enter, and then as it goes down here, I'm taking profit as we're getting into the depths of this liquidity. You see here we take profit 1, and then it goes back up, we're taking profit again, and then here we're all out, and we have to do all this in laser time. This is only a couple minutes right here, and then there's another chart, we're doing the exact same thing, maybe the other way. And it's so easy. You guys already know how easy it is to mess up. Let's say we take profit right here. Long term, that ruins us. The difference between here and here, it doesn't look like much on the chart, but when we do the maths, it is so much we're missing out on. It is a quarter of the trade, and half of our trade, losing that much, half of the trade like that, over time, we're going to be screwed over. And then there's another trade right here. Where do we take profit? Do we take profit here? Do we take profit here? If we get even just a little bit of it wrong, if we take maybe 50% out here instead of 50% here, because we measure the liquidity wrong, because there's liquidity here and there's liquidity here, and when we're laser focused, we need to define which liquidity we're going for. We're going for this one or this one. And if we take profit here, maybe we take half of it out here and let the rest run. That means we only have half of our profit going up, and that means we're getting half of this move instead of the full move. So we're only getting, let's measure this. This is 10 points. All right, it's not much, but our stop loss is only 12 points, so it does add up. When we take profit half here, this 10-point move becomes a 5-point move because we only have half of our exposure in this trade. And now a 5-point move, it's really nothing to us. And we've just made all of this move nothing. Little decisions like that can really affect you. That's why we need to be laser focused all the time when we're trading, and the risk of that is losing small amounts over time like that. And if we go back to this, just small amounts can go from profitable to break even. And there's actually more to the R2R thing I wanted to talk about as well. So I think risk to reward is a very basic concept. And when we want to go, because if you're in the server, let's be honest, we're going to be a lot more than just profitable. We're learning from reality, and reality, he is one of the best traders in the world. If I'm being honest, nobody is out there like reality. He has a ridiculous win rate, and if you're in the server, you already know that, and you're probably aiming for a lot more than just borderline profitable. So we want to use different techniques to measure our profitability than just basic stuff like R2R. Because if we look at our chart again, this is not consistent at all. This is a 2R trade, this is a 1.5. We can't really just log this and call our strategy a 2R trade when it's different every single time. Our trades depend on market structure. As we become good traders, we use different things like market structure, levels, dynamic levels, price action. We don't just take profit at 2R or 3R or 4R. We take profit at levels. Like here, this is a level because of the market structure right here. This is the bottom of the structure, so we take profit down here. This is the pool of liquidity reached right here, so we take profit here. You see, this isn't 2R every time, because then we're actually gambling. We're just not using the logic the market provides us. So instead, what we can use is what I call point to point. we measure the points gained and the points possibly lost from each trade, and we use that to measure the best variant of each strategy. So this is the same strategy with different variations, and I tested about 30 trades here just on this spreadsheet alone with the different strategies I could use, the different variations of the same strategy. So this variation here is taking profit at structure. This one is taking half out at the first level. This one is taking out half at the first level and then a break-even stop loss. Because without a break-even stop loss on this one, we could let our trades run a lot more. Since we're on the 1 minute, it's a lot easier to get stopped out at break-even. So I wanted to try to test this one and this one separately. And then this one, I had 2 different stop losses. You see how easily this thing can get complicated and how we have to test a lot more complications than just risk to reward here. This is multiple stop losses. How on earth are we going to use risk to reward to measure this? So we don't. We use the point-to-point method. So right here, this is how many points we win, and this is how many we lose if we lose the trade. But we don't. So we put 0 if we lose the trade, and then at the end of it, we add it all up, and then we have how much we won and how much we risked. So right here, we risked 155 and we won 459. With the other variation, the double entries, we won 536. And that's what we're actually looking for. We don't really care about this win rate in bullshit, the risk to reward bullshit. What we care about is how much we win. We trade for profit, not win rate and risk to reward. But if you really care, if someone asks you, hey, what's your win rate? You can always just add it all up, take it away, and find the percentage. But right here, we see which one very clearly is the most profitable. This one is clearly the most profitable, 536. The rest are all lower. They're about 420, 300, 300. And also, if you really want to, you can use this number, the amount risked, for different variations, different things, like calculating how much you can risk. So say we trade on a funded account, we get a 50k account. Usually that's a 2.5k buffer. And this is 30 trades. To find out the average stop loss right here, we take 516 divided by 30, about 17 point stop loss. And then we can plug that into a calculator to see how much we risk with each micro. So with 5 micros, we're risking about 170. With this win rate, we can get away with that on a 2.5k buffer account. Yep. That's about everything so far that I have. If there's any questions, type away. Does anybody have any questions on what I've went through so far? I did go through this pretty quick because I don't usually do public speaking and I'm a bit of a rambler. So
I think you did really good, Joshim.
Yeah, I want to do live trading again, .echo, but I am busy sometimes. I will try and join the lives again. Yeah, Unity's a pretty shit server compared to this one.
YouTube, Kick, Twitch, Rumble. Anybody have any questions? I'll relay them to Joshim if you have any. Hey Ace, good afternoon.
I think the most important part about this lesson is not the risk management of trading itself, but the idea that risk management has layers that goes beyond just trading. So like the sleep thing that I was talking about, how that comes with risks. And then managing the risk of sleeping comes with its own risks, like how I was taking those drugs to try and sleep, those had risks. And then not taking them also has risks. Everything has a risk. And managing the risks also is a risk. even right now, I can find something with risk management. I have energy drinks on my desk right now. The risk of taking them is I become reliant on caffeine. The risk of not taking them is I don't perform well enough through the day. I feel unfulfilled because I don't have enough energy. Everything has a risk, and managing the things with a risk also has a risk. Yeah, some drugs are crazy.
What's crazy about it, even more so than that, is the fact that now they make drugs for the side effects of the drugs that you're taking. So you take one drug to help your depression or whatever the case may be, and now you've got some kind of, eye twitch or something. Now you take another pill for the eye twitch, and then that gives you side effects, and they give you another pill. Absolutely amazing. Just crazy.
That's the whole big pharma thing. Big pharmaceutical companies trying to profit.
I do not take any of those pills. I know that some people say that you have to take them, because you have this condition or that condition, but I just refuse to take any of that stuff.
The best medication is a healthy diet.
I agree with you 100%.
Just another example to show you guys how many risks there are. The risk right now of you sitting here watching this is your posture. A lot of the time when we're trading, we're sitting down, and we manage that risk by getting up and going for walks. And then there's also the risk of having bad posture. What does that actually do? Why does it affect us? It makes us feel sloppy. And then even that posture actually affects your trading, because you don't feel as good, you won't trade as well. Everything's interlinked.
Did Landon actually make it? He's here. I wonder if he's actually here.
He sent me a message saying meet.
Okay. Five years. No trouble, only benefits.
Another thing we could show off that isn't directly correlated to what we've talked about so far is the different ways to manage your trades and to managing risk. So you can, something a lot of people ask me about is how I ladder out. I always talk about how I have multiple stop losses and multiple take profits sometimes. So when you're trading with a small stop in fast action paced environments like the 1 minute trading, a lot of the time it doesn't take much to take you out of a good trade. So I'll try and find a better example. There was one recently where there was a really nice trade, but it just got tucked out a little bit by a wick. So right here, maybe what about this? Yeah. Right here, there's a really nice pool of liquidity. We might look for a short here and say our entry is the break below this level, the second break. What if we get filled here? Nah, fuck that. That's a bad one. What if we get filled right here the first time, and we're scalping it, so we have a small stop. If we get wicked out just a little bit like this, see right here, that's a huge trade lost because of a small wick. So we can have multiple stop losses. Stop 1 could be here, stop 2 could be here, stop 3 could be here. So the difference between doing that and having just one stop loss is that we get stopped as the trade goes up instead of getting stopped all at once and losing all of the trade just because of one small move. And that's what's called the dynamic price profitability. And it's like right here we get stopped, but we still have 60% of the trade in. So we've only been stopped 30%. And as we go up, our profitability changes. So if we get stopped again, we only have 30% in, but our win rate will be a little bit higher since we have a higher margin for error. And you could do the same thing the other way around. So I was always looking for ways to maximize my profit. This is where it's really started. Was I would always look for ways to maximize profit. I would be confused. The rules would always be different every time, and I just wanted something that would be consistent. But I'm a perfectionist, and it would never be consistent. So what I realized was I need to have multiple take profits, and I can't just do one take profit, one break even. I need to have multiple take profits. So when I was scalping really fast, I would have something like this sometimes. I would get a entry like this, and it would go down just a little bit, and it would hit a level, but it would instantly go back up and stop me out on the trailing stops. So instead of having trailing stops, I tried multiple take profits. I'd have take profit 1, take profit 2, take profit 3 as it went down instead of as it went back up against me. So what a lot of people like normal traders will do is they'll have a trailing stop. They'll enter here, and when they hit their first take profit, they'll put their next stop loss right here in profit. And if it goes back up, it'll hit them. But when you trade in on the 1 minute, you just get stopped every time if you take a quick take profit. So instead, you can have take profit 1 here, and then as it goes down, you can have more take profits, and then just keep your stop loss wherever you want it. And you can just test that against different things to see which one is the most profitable. So with risk management, you can get very, very creative. Yeah, multiple stop losses has been very useful. So especially when you trade in on a low time frame, I'll just draw it because it's quite hard to find the perfect example. So like let's say we've got a pool of liquidity here. We want to catch this big rise in green candles, and then we're looking for a short, so we get some structure, and then we're looking for the break below the structure. So since we're using the structure as our entry, we're probably going to be using the top as our stop loss. It could easily go back up and retest structure and have a little wick that kills us and gets us out of this big move right here, and we get stopped right there. But instead of having one stop loss right here, we get stopped on the whole trade. Instead of having one stop, we can have stop 1 here. How do I draw a line? Stop 1 here. Stop 2 here. And stop 3 here. So when we get stopped here, we have lost 30% of our, wait, there's 4. We've lost 25% of our position. So let's say we'll make the maths easy. We'll do a 100-point stop loss. Oh shit. Let me use text box. Where's text box? 100 points divided by 4, we've lost 25 points. And then here we lose 25 points here. So we lose minus 25 here, minus 25 here, and minus 25 here, instead of losing all 100 here. And this also has a different effect too. So the effect of this is we have less in the trade. So we're losing 25% of our trade as we go up. So if we go up to, let's say we lose 50% of our trade, we go up to here. Now we only have 50% in our trade, and we'll need 2R to get back to break even. So you can see how it's not perfect. It's not like a easy way to make easy money. Obviously, it has its drawbacks, but it's a way to survive a good trade and its inconveniences, like getting stopped out by a little wick like that. You don't want to get stopped out on a big trade like this, but there's always the chance, and we run that chance by having only a percentage stopped out instead of the entire trade. And as it goes up, we'll get stopped out more and more. I'll show you the other way around as well. So right here, normal stop loss just below the low, take profit up here. Instead of one stop loss, we have another stop loss here, another stop loss here, so that if it were to come down and stop us out right here, we don't get stopped the entire trade. We only lose a percentage. So does the trade need to have 100 tick? No, the 100 tick, I only use the 100 ticks because it's easy to divide by 4. It's just an example. Yeah, so usually my stop losses are about 10 points, and the first one will just be slightly above, and then maybe only a couple points more. That's pretty much everything I have. If anyone has any other questions.
Thank you, Joshim. That was really, really, really good. If anybody has any questions, YouTube, Kick, Twitch, Rumble, anybody there? Missed the start, but I assume reality is yes. Paul. Back and catch it on the videos. I'll drop a link too. Well, there's already one in the main chat. You should be able to actually just go through that one, but I'll put it in the live education as well. Yeah. Ace, have a great weekend. Appreciated the info. Absolutely, Ace. I appreciate you showing up. Well, I'll get the schedule for the next one. I don't know exactly when yet. I'll get with Joshim and Landon and see when we're going next week. And I'll let everybody know once I have that info from them. Anybody else have any other questions, guys?
Yeah, so you can use a bigger stop loss with just the same risk. It helps you stay in a lot of moves where you might get stopped out. But it's definitely something you need to test before you use, because there's a lot of complications as well. Like as you lose, you need to make more to get it back, if you know what I mean. Since you have less in the trade, the more you profit is worth less. Well, I think that's about everything, so I'll see you guys next week then.
All right. Thank you very much, Joshim.
Thanks for showing up, everybody. I hope you learned something.
Absolutely. Absolutely. All right, guys. Have a great weekend. And I appreciate you, Joshim, and I appreciate everybody else for showing up. As always, guys, stay consistent out there.